Hey everybody, I'm Susan Galinsky.
And I'm Denise Grace, and we're the founders of G Squared. So, for the best information and advice on how you can have a successful retirement, subscribe to our YouTube channel, and don't forget, hit that notification bell so you'll be notified anytime we upload a new video. So, before we begin, you might notice, if you've been watching some of our other videos, that our scene has kind of changed. That's because Susan moved down to North Carolina and deserted me. But we're working on recording from our two different locations so we can continue to bring you our educational videos. So we hope you like the new look as much as we do.
Yep, got new software, etc. And you'll probably notice I got a little more of a southern twang. Not a lot.
Not yet.
Okay.
Not.
So let's begin. And today we're going to talk about a topic that I think is really a good topic for us to look at. And that is the Trump tax cuts. Okay. This was something that was put into effect in 2018. And I'm going to discuss what those were, how they affect us, and when they're due to expire. And not only that, but before I talk a little bit about that, I want to say if your current financial advisor is not talking to you about this, you seriously need to scold them, or you need to come talk to us, okay? So let's begin. And I'm going to go to the next slide. And this is what we're going to look at today. And that is, and I apologize for that, what our agenda looks like and what we're going to review. And probably the first one is obviously history repeats itself. And we want you to prepare accordingly. And we'll actually show you a chart to show you how history repeats itself. And then secondly, taxes are on sale. Okay, we've got 1.5 years approximately till the current tax rates go away. And that means you can pay now at a lower rate, or you can pay later at a higher rate. And naturally, we're going to tell you to do number one versus number two. The standard deduction decreases significantly. And then we want to talk to you a little bit about what is really key here, and that's the pros and cons of a Roth IRA. So let's begin with briefly a little history lesson here. And if you look at this slide, and I know it's a little bit of an eye test, and I apologize for that, but it shows a history of U.S. tax rates, okay? And the Tax Act was actually put in place 2018. And to get it through both Congress and Senate, they only put it in for a limited amount of time, which means that now it's going to expire in 2025. Okay? And the one thing I want you to think about is that this act was significant because it gave everybody a tax break. And when you look at the history of U.S. tax rates and the top tax rates, you'll see they've been as high as 92%. So when we say history will always repeat itself, God forbid we're going to go back to these rates, but there's a very strong likelihood that after this act retires or expires next year, you're going to see the same thing where rates will go up significantly. So history can and will repeat itself. And so we want you to take advantage because you only have until 12/31 of 2025. Because we want you to pay that lower rate versus the higher. So let's talk a little bit about what the rates look like now as opposed to what the rates are going to look like after 2025. Denise?
So this chart compares where we are right now, the 2024 column that represents the tax cuts that did go into effect in 2018 and, like Susan said, are about to expire at the end of next year. And then we've got the 2026 tax rates. That's what they're going to go back to. Now, the dollar thresholds for 2026, those are estimated numbers. All we could do, and all analysts have done so far, is go back to the 2017 rates, before the tax cuts started, adjust them all for inflation, and try to bring them up to today's numbers. But again, those thresholds are estimates, but they give you a good idea of where we stand now versus where we're going to be in 2026. So the key part here is if you look down at the tax rate, 2024 versus 2026, and you can see the 10% will stay at 10%. 12% is going up to 15%, 22% up to 25%, 24 all the way up to 28%, and the 32% only up 1 point up to 33%. And on down, and if you look at the last number, 37% goes all the way back up to 39.6%.
Right. And Denise, I think another thing worth noting is the bands of the income, because all of a sudden they get wider, which means it's going to encompass a more significant population in them.
Another big significant change is the standard deduction. With the Tax Cut Act, the standard deduction was pretty much doubled for single and for married. In 2026, those numbers go back down to where they were before. So you can see, it's like half as much as they are right now. And another big change is the estate tax exemption. That was brought all the way up to $13,610,000, and the rate was reduced to 40%. In 2026, again, those numbers are going to be pretty much cut in half. And more importantly, the rate is going up from 40 to 45%. That's going to affect not necessarily, middle America, but the reason those exemptions were increased is because when people who own property like farmers, that's a huge estate if you look at the cost of the land, and when it comes up for estate taxes when the owner dies. So that's going to make a big difference for people in that population, like business owners, farmers, people that own a lot of property.
Yep. And so how do you strategically prepare for that? Knowing that probably after 2025, you're going to end up giving away more of your declared income to the IRS. So obviously, the tax brackets matter. And with our clients, what we look at is doing some Roth conversions or a series of conversions. And that way we can calculate what the anticipated taxes are going to be for them if they want to stay within a certain bracket. Okay. So right now, again, initially I said taxes are on sale. Taxes are on sale. So look at it this way. Do you want to pay 17 cents on the dollar, or do you want to wait, let the new tax rates go into effect and pay 25, 35, 40 cents on the dollar? Very important. So, and it's very important too, as you're thinking about retirement, you want to maximize that income. You don't want to give away more to the government. So you may wonder, why is this so important too? Well, you're probably, and many of our clients are in a position where they have significant money in what's called pre-tax qualified accounts. So what are those again? That's your traditional IRAs, that's your 401ks, that's your 403bs. And as you look at that money and you start going closer and closer to retirement, and you're thinking about withdrawing that because you're no longer drawing a salary, well, all of that 100% is considered income. And when you add that to present income, whether it be Social Security, pensions, if you're lucky, any other form of revenue, then all of a sudden we find that a lot of our clients are in a position where they're actually paying more taxes in retirement than they did when they were working. So Denise, let's talk about an actual case study.
Well, an actual case study, a couple that we worked with in Susan's new state, North Carolina. Their adjusted gross income is around $150,000 a year, but they have a substantial amount of money in qualified money, being pre-tax money. So they're over 59 and a half, so they're right for doing some Roth conversions. So we look at, that sweet spot, the tax bracket between 22% versus going up to 25%, or even the 24%, which is going up to 28%. So we look at, what is their current income now? How much can we start converting, paying the taxes now rather than pay them later, and convert that money over to a Roth IRA? So like I said, the sweet spots, when we work with people, we look at how much can they take out of their qualified money, pay the taxes now, and still keep them in that 22% tax bracket, or even go up to the 24% tax bracket. Because as much as we can get out now, pay those taxes down now versus later, the better off they're going to be later when these tax cuts expire. So, the sweet spot is something that when we work with clients, we manage toward that, that limit that they can afford to pay the taxes on, because yes, you're going to have to pay it now. But again, it's like you want to get that money out now. So obviously this strategy is really specific to each person. That's the kind of planning that we do. And, in this video, we're not going to give you instructions on what to do or how to do that. Like I said, it's really dependent on your income, your current situation. And, there are people who say, well, I'm going to have a lower income when I retire. To tell you the truth, it's very rare that we meet a couple whose income is lower in retirement, because by the time you add in Social Security, add in a pension, and then you've got your withdrawals to live off of, in so many cases, you're in just as high an income bracket as
yeah, and the other thing you have to add in too is that the government at some point is going to make you do required minimum distributions of that pre-tax money.
Yeah.
And if you've got a huge boatload there, and that's going to add a significant amount to your bottom line.
Right. I've got one client that I worked with that's got over $2 million in qualified money. And while he's all proud of himself, for how much he's saved, if you look at what he's going to have to pay once he starts his required minimum distributions, it's over $80,000 that he's going to have to take money out and pay taxes on top of Social Security, on top of everything else. So yes, quite often for most people, it's better get that money out as soon as you can, get these taxes paid down at the lower rate rather than waiting until they go back up.
Right. And, and then now here's the Achilles heel, which is, well, if I take some money out now, or I do some conversions to Roth, then I'm going to have to pay taxes. Mm-hmm. Nobody likes to pay taxes. Yes. Ouch. It hurts. Right. But let's talk about some of the pros and the cons to converting qualified pre-tax money now into a Roth IRA. So first of all, I like to look at the bad news first, then we'll go to the good news. Yes, it could increase your Medicare Part B premium for a year, because your Part B premium is based on your income, okay? But I think that it's one of those things where there's an old saying in the South, suck it up, buttercup. I think this is a great example of when you should do that. And taxes eventually will have to be paid now, because stretch IRAs are gone. We used to have this wonderful rule that said, something happened to you, you've got traditional IRAs out there, they can be rolled over to your children, they can continue to grow that account until they want to take it out. Well, that no longer is true. They're going to have to take it out if there's a death and they were the beneficiary. They're going to have to take it out in a designated amount. They're going to have to pay the taxes. One other caveat, if you've never had a Roth IRA and you have to establish it for the first time, there is a mandatory 5-year waiting period to access the money that's in those accounts. Okay, let's look at the pros though, because I think they far outweigh the cons. Once converted, all the interest and the growth going forward, 100% tax-free. It could significantly reduce your future tax owed, because of course you're paying now versus paying later. It protects the money for widowers and heirs. because, as I said, if that money's still sitting in the pre-tax qualified accounts and something happens to you, now your widow or your heirs is most likely going to have to pay taxes much sooner than later. RMDs, required minimum distributions, they do become more manageable in lower amounts because you've done the conversion now versus waiting till you have to do the RMDs. And what's interesting about the Roths is the Roth is the only vehicle out there where income from it is not included when they're calculating your Social Security taxes. So that is a big plus of, again, lowering your future tax bill. So when you look at this too, I want you to think about one other thing for the widowers. When we have the advantage of being able to file married joint, it's a lower tax rate than those people who are single taxpayers or head of households. Okay? So again, when you're looking at that, if she's going to lose, she's obviously, let's use a female example, that the male went first. She's going to lose her Social Security. She's going to get his, but there's already one cut, okay? Then she's also probably going to, if he had a pension, she's probably only going to get a percentage of it. Again, a lower income. But then if she inherits his IRA, RMDs are still going to have to come out of that, which is going to increase her income and at a higher rate because she's now single. Did I miss anything there, Denise?
Standard deduction is down to 1 instead of 2. So yeah, it makes a big difference when you're filing taxes single versus filing married. And that's one thing that we've seen that so many people don't plan for, or their current advisor has not helped them plan for, is you're going to become a widow or a widower at some point in your life. And, you know, if you have to plan for that tax change, otherwise it just, you know, it's a shock when you've already been shocked by losing a spouse. So it's really important to know about it, be aware of it.
And be prepared, right?
Yeah.
Yeah, absolutely. And is it fair? No, absolutely not. It stinks. But it's a reality that we have to deal with. And like Denise said, we'd much rather have you plan for it than have it be a big surprise.
So obviously we've covered a lot in this video in the last few minutes. But the point is that being aware of what's going on and having, most important, a written plan, which is what we provide our clients, a written plan that will get you to and through retirement. There are a lot of other changes. I just put this slide up here, not to confuse you, but these are all of the changes that are affected by the end of the Jobs Act, the Tax Cut Act. Not going to go through all of them. Obviously, we just touched on the important points, but we can include a copy of this in a download for you on the video. So what we want to get through to you today is planning is very imperative to having accessible retirement. You don't have to figure this out alone. We are here to help you. All you have to do is click on our Calendly link and we can set up a time to meet and just, you know, have a conversation, see if there is something that we can help you with.
So if you liked this video, please give us a thumbs up. Remember to subscribe so then you know when updates are happening. And we hope something really good is going to happen to you today. And as usual at G Squared, we believe that relationships, building those relationships
Beyond investing.
Yeah, beyond investing is really important. Take care.